Absolutely. All right, guys, let's begin. Um, so a lot of things going on in the world and in the United States, and we're gonna try to cover a lot of the hot topics. And somehow I feel that they are all interrelated. And honestly, today, with the U.S. government, the U.S. Treasury, stepping into the market and announcing that beginning in September, they're going to begin to buy back government bonds in the 10-year to 20-year sector. That's the segment of the market that they're going to begin to buy. They announced they're going to buy $4 billion worth. Um, and that sort of captures what the Trump administration is really worried about, and that's we're going to get into that. Um, Now, the title today of this topic is tariffs, the Fed, bond yields, government buybacks, and the war. They're all interconnected, and it's a mess. So that's the topic, and we're going to jump into it now. So when Trump took the presidency from President Biden, it's no secret that he inherited a very high inflation environment from Joe Biden. We're all well aware of that. Now, that inflation was due to a combination of factors. Of course, we had the shock of COVID that led to a dramatic reduction in the supply of many goods and services in the economy. When you have a cut in supply, that and you still have demand running at a pretty hot rate, that causes price pressures, a mismatch between demand and supply. Prices go up, and the government on top of that, in order to try to pump the economy up, it started spending a lot of money. The Fed had kept interest rates very low for a long time, and we just had this explosion inflation that peaked in the summer of 2022. The inflation rate peaked at about 9%, and very gradually that inflation rate started to come down. But by the time Trump came into the executive branch, inflation was still too high, still well above the Fed's 2% inflation target. But it was edging down very gradually. Even back then, we were hearing the term sticky inflation because inflation, while gradually declining, it was coming down very, very slowly. And into that environment, Trump announced his tariffs. And because tariffs were on imported goods, the price of imports shot up, and that added some more inflationary pressures to the economy. Um, Now, Scott Bessent, Trump's Treasury Secretary, uh, quickly announced, even before President Trump took office, Scott Bessent announced that he was going to try to reduce the fiscal deficit to 3% of GDP. Under Biden, that deficit had reached a whopping 6% of GDP. So Bessent said, we're going to cut that in half by the time the Trump presidency ends. Now, why is that important? Because one of the inflationary pressures was probably due to all of that government spending, which adds some extra stimulus to the economy, boosts demand, and um, and that contributes to the mismatch between very strong demand and supply. Now, unfortunately, that Doge plan to massively cut government spending, it turned out to be a flop, and there was very little tangible cuts in spending. It was a nice idea, but nothing was really operationalized in any significant way. So we continue to be stuck with this very large fiscal deficit, which really continues to be about 6% of GDP. So really no progress in reducing that deficit. Scott Bessent's pledge of reducing the deficit to 3% of GDP now just looks like a fantasy that is never going to be realized. So we've got big government spending, the inflationary impact of those tariffs still lingering with us. And then what happens is on February 28th, we get the initiation of the war on Iraq. Now, if that war had been fought successfully, then the spike in oil that we got would have quickly dissipated, oil prices would have normalized, and we would have probably been mostly done with the inflation scare. But that's not what happened, right? We know that on April 8th, instead of persevering and continuing to push through with the war, the Trump administration put the brakes on and began to negotiate. Well, he announced the ceasefire and began to negotiate what was known as the Memorandum of Understanding, with the goal of keeping the Strait of Hormuz open. But Iran had different plans, and despite what President Trump has said, the Strait of Hormuz continues to be disrupted. We'll get more into that topic a bit later. It continues to be disrupted, and oil prices remain a source of inflationary pressure. So we have the large fiscal deficit that contributes to inflation. It also, a large fiscal deficit means that the government is borrowing a lot of money, right? They're issuing a lot of debt, a lot of bonds. That puts, together with inflation, that puts upward pressure on bond yields. You have all this supply, and if investors are going to take down that supply, if they're going to buy bonds, they need to be enticed with higher and higher bond yields. So bond yields have been creeping up. The war, because it has caused this sustained higher oil prices, you have an additional inflationary impulse from that. That's also putting upward pressure on bond yields. And then if we just go back to end of July, when Kevin Warsh gave his second press conference as Fed chair, he gave a little bit of a muddled, or more than a little bit of a muddled, I call it maybe the worst press conference I've ever heard of any Fed chair. He gave a muddled, bungled message that investors really couldn't figure out if he's serious about bringing down inflation or not. And investors came away from by thinking, you know what, the Fed is probably not going to raise interest rates. And because of that, inflation expectations continue to sort of rise. The Fed has lost a little bit of credibility, and we've seen steady upward pressure on bond yields since that July 29th press conference. And the dollar has really fallen out of bed. And that too is linked to the muddled message delivered by Scott Bessent, and just a loss of confidence in the Fed that they're actually going to get their inflation under control. So that brings us to this morning, right? The government is under a lot of pressure now. They're seeing bond yields move higher and higher. They hit the 10-year bond yield hit 4.72% just the other day. The 30-year bond yield crossed 5.3%. Remember, mortgages are linked to the 10-year bond yield, so there's a lot of political pressure for the government to do something about these rising bond yields, rising mortgage rates, just before midterm elections. So that's why we got this announcement today that the Treasury is going to be stepping into the market starting in September and buying 10-year to 20-year bond yields. Now, with this announcement, the dollar took another tumble, because the way the market sees this, if the government is going to be buying bonds, right, the implication is that means they're going to be printing money. They're going to be putting money into the economy. Now you've got this flood of supply of dollars into the global economy, and the dollar takes a tumble. But is that what the Fed is actually going to do to help the Treasury buy back those bonds? No, they're not going to print money. That's not what's going to be happening here. What the U.S. Treasury is going to do in order to buy back 10-year and 20-year government bonds, it just means they're going to be issuing shorter term bonds. They're going to be issuing 2-year bonds and 5-year bonds and 7-year bonds. So what we should see is the yield curve begin to flatten. That is to say, the longer end bond yields should come down, higher end bond yields are likely to rise, but there's not going to be any money printing. But the interpretation from the market is we're going to see money printing, and the dollar took another significant tumble today. Now, the next time the chairman of the Fed is due to speak is on August 28th. That is going to be a very, very important press conference because, as I mentioned, some of these rising bond yields, especially since July 29th, when before Kevin Warsh spoke, that 10-year bond yield was trading at about 4.55%. As I mentioned, as of yesterday, it shot up to 4.72%. So that rise was mostly driven by Kevin Warsh sort of fumbling his press conference. So he's going to speak in Jackson Hole, Wyoming. This is a major, major conference that takes place at the end of August every single year, where policymakers from all over the world make important speeches. And very frequently, the chairman of the Fed uses that moment, that conference, to deliver an important message. So let's talk a little bit about Jackson Hole and the setup to August 28th. So based on the 2 times that Kevin Warsh has made public presentations to the markets, we have a clear sense of what Kevin Warsh doesn't like that the Fed is doing, what he really dislikes about Fed practices. What doesn't he like? Kevin Warsh has told us very clearly he does not like forward guidance. That is to say, he doesn't like when the Fed gives messages to investors, to the markets, as to what their next move is going to be. Now, the Fed doesn't say it clearly, but they send subtle messages, and experts in the market who follow the Fed are pretty easily able to pick up what those messages mean, and we're able to make pretty good educated guesses whether the Fed plans to raise interest rates, cut interest rates, or leave interest rates unchanged. So Warsh doesn't like that. The reason why he doesn't like forward guidance, he really cites 2 reasons for not liking forward guidance. The first reason is that Warsh thinks that when the Fed signals to the market what their next move on interest rates is going to be, it makes it very difficult for the Fed to change its mind, right? If they send signals, it boxes them in. And if they want to change course, it makes it very, very difficult. And Warsh, not recently, but in the past, he has cited 2021 as an example of what he means. What was happening in 2021? Well, we were coming out of COVID. The Fed was keeping interest rates at zero, basically from March of 2020 all the way until December 2021. And inflation was taking off, and the Fed really felt boxed in, right? They felt like they couldn't change their mind. At least that's Warsh's interpretation. Now, I don't think that's exactly what happened. I think the Fed could have changed its mind, but Jay Powell chose not to. Why? Because, and I've spoken about this many times, not recently, but in the past, Jay Powell was up for a reappointment, for renomination at the Fed, and he did not want to give Biden an excuse to not reappoint him. So he wanted to keep interest rates very, very low, to keep stimulating the economy, to keep Joe Biden happy. And that's the reason, in my opinion, why the Fed didn't pivot and raise interest rates earlier, right? They waited all the way until March of 2022, until Powell was renominated and sworn in as Fed chair for another term. So he waited until his position was secure, and then he raised rates. But Warsh's opinion is different than mine. He thinks the Fed waited so long because they had boxed themselves in. They had sent signals to the market that they weren't going to raise interest rates, and it took them a long time to wiggle out of that position that they had boxed themselves into. So that's the first reason why Warsh does not like forward guidance. The second reason he doesn't like forward guidance is that he thinks forward guidance gives investors too much comfort, right? It's too much hand holding. And when investors are very confident of what the Fed's next move or next few moves is going to be, it it sort of implicitly, tacitly encourages them to take more risk in their bets in the market. It gives them a sense of confidence that they wouldn't have otherwise. Um, so that's his view. Here too, I disagree with him, and I'm going to just tell you why. I think that if you look at the financial market collapses that we've had in the two last, real financial market collapses where there were big excesses that were built up in the market. They were 2001, that was the dot-com bubble, and 2008, that was the great financial crisis due to excessive pricing in houses and mortgages. Too many uh, mortgages were given, subprime loans. That had nothing to do with forward guidance. Why? Because forward guidance didn't exist before 2008. Forward guidance came into existence after the financial crisis. Why? Because the Fed wanted to give assurance to investors, to markets, that they would not be raising interest rates anytime soon, right? The Fed believed that it would take a long time for the US economy to recover from the 2008 financial crisis. And they didn't want investors to start to expect that the Fed might begin to raise interest rates prematurely, because if market rates started to go up, that could cut off the economic recovery. So the Fed started this practice of we're going to give forward guidance to ensure that bond yields don't start to rise and cut off an economic recovery. So you could argue, and I think it's reasonable to say we don't need forward guidance anymore. It's outlived its usefulness. Yes, it was necessary in 2008 because we wanted to make sure bond yields didn't rise over the next few years and choke off an economic recovery, a fragile economic recovery, but we don't need that anymore. We're not in that situation. We don't have to worry about bond yields rising. Um, so that could be a reason, right? It's just outlived its usefulness. But Warsh's argument is different. He says that forward guidance causes bubbles, right? It gives too much comfort to investors. Uh, but I just presented, since 2008, we have not had any of those bubbles. So there's no evidence whatsoever that demonstrates forward guidance leads to bubbles. In fact, the last two bubbles that we had occurred when we had no forward guidance. Now, I just want to go back to this morning's announcement, right? This morning's announcement that the US Treasury is going to buy back bonds. Why are they going to buy back 10-year and 20, anywhere between 10-year to 20-year bonds? Because they're very uncomfortable with the rise in bond yields, and they're concerned that bond yields are going to continue to go up and up and up. Okay, so they're buying those bonds. Now, if you want to hold investors' hands and let investors know that bond yields are capped, that they're not going to go up anymore because we're going to step into the market and buy them. Okay. And if you want to prevent investors from taking excessive risk, guess what you shouldn't do? You shouldn't do what Scott Bessent just announced today, because he just effectively put a cap on 10-year bonds through 20-year bonds. Now, if Warsh, on the other hand, had given a really credible press conference on July 29th and sent a really clear signal that the Fed might raise interest rates because they don't want inflation, the short end, that is 2-year bond yields, might go up, but inflation expectations would start to come down. And as inflation expectations came down, in all likelihood, 10-year bond yields and 20-year bond yields would start to come down. So I actually believe that Kevin Warsh made a bit of a big mess. It all started with the announcement of Trump's tariffs, right, which caused inflationary pressures to increase. Then Trump not persevering with his war and getting this thing over with, but in his foolish attempts to try to negotiate a ceasefire with Iran, who has no interest in a ceasefire, right? That's maintained oil prices at very high levels. That's added further inflation pressures. Going back to Scott Bessent, they're not cutting the government deficit, right? They're issuing just as much debt as they did under Biden. That's putting even more pressure on government bond yields. So we've got this vicious cycle we're in right now, and we get today's announcement. And now, of course, the stock market loves it, right? The stock market loves it. The stock market, at least it was rallying before. It's still up. The dollar hates it because to the market, this looks like a repeat of money printing. None of this is good for the inflation outlook. So this is really quite a mess that's been created from the government standpoint. Now, I covered forward guidance, right? I covered forward guidance, and I talked about why Warsh made a mess of his press conference. But I really haven't touched on the most problematic parts of his press conference, and that's what I'm going to get into now. Forward guidance, okay, if he gets rid of forward guidance, I don't think it's a bad thing. I'm sort of indifferent on it, but um, but here's where the real problems begin in his press conference, and this is what he's going to need to straighten out on August 28th. So every central bank has what's known as a reaction function. What is a reaction function? A reaction function is what the Fed looks at, what economic data do they look at that causes them to either raise interest rates, lower interest rates, or leave rates unchanged. Okay? So the reaction function is, if I'm the Fed, what am I looking at to know if I should change my policy or leave policy as it is? So what did Warsh say on July 29th? He said that the Fed will achieve its 2% inflation target. Okay? That is not debatable. He was crystal clear about that. He also said that the Fed has missed its inflation target for 5 consecutive years. And that was a choice that the Fed made. Okay? That's his view. It's a choice that the Fed made. They made a choice. They could have been more aggressive in raising interest rates. That's the implication, and brought inflation down to 2%. And then Moore says, I'm going to choose differently. The Fed from this point forward will no longer miss its inflation targets. So that sounds very serious and very positive. And in fact, his first press conference, if we go back to his very first press conference in June, that was pretty much the only thing he said. And he repeated it again and again and again. The market was impressed by it. But in his last press conference, he failed to tell us what data he's going to be looking at to determine whether or not inflation pressures are rising or falling in the US economy. Okay? So historically, the Fed has used the PCE inflation index, and the jobs numbers, the employment numbers, to determine whether or not they should be raising interest rates, cutting interest rates, or leaving interest rates unchanged. If the PCE index is rising, they should probably be raising interest rates. If the employment situation is booming, tons of jobs are being created, and inflation is kind of sticky, they should also be raising interest rates. On the other hand, if the PCE inflation is well controlled and the employment situation is kind of soft, then maybe they want to leave interest rates unchanged, or maybe they even want to cut interest rates. Okay, that's what the Fed has looked at historically. They also have looked at a bunch of other indicators, but those have been the two most important. But Warsh, in his press conference, said that he doesn't think PCE inflation is really the best measure for inflation. And he says that employment indicators that we look at can also be very inaccurate. On top of that, he said that AI might be disinflationary in the long run. That is, it might lead to low inflation in the long run. But in the short run, because there's all this demand for AI products, it could lead to inflation in the short term. He also said that the bond market provides very important signals about inflation. Okay, so bond yields have been rising. So therefore, maybe that's telling him that he should be raising interest rates because the market's concerned about rising inflation. But then he said, even though the bond market is really important and can provide signals to us, he also said, but it can be completely wrong. So the bottom line of Warsh's comments on July 29th was that he seems very confused about what inflation measure to look at, what employment measure to look at, whether the bond market is telling him to raise rates, or maybe the bond market is sending improper signals. And therefore, it seems like he doesn't know what to do with interest rates. So the market is absolutely baffled and lost a bit of confidence in the Fed as a consequence of that press conference. And again, that is precisely why, since that press conference, we have seen a weaker dollar, a significantly weaker dollar, as well as rising bond yields. It's a loss of confidence in the Fed. As I mentioned, bond yields today, they came down because to 4.66%, because of the announcement that the government, I'm talking about 10-year bond yields, because of the government announcement that they're going to buy 10-year bonds, but they had reached 4.72% from yesterday, and they had been 4.55% before Warsh became Fed chair. Or I should say right before his July 29th press conference. So that's a 17 basis point rise in bond yields. That's pretty significant. Mostly due to what I just discussed, this lack of clarity when it comes to the Fed's reaction function. Now, there's one more topic that he mentioned, that he brought up at the last press conference, that also contributes to the confusion and the lack of confidence in the Fed. Warsh said repeatedly that he likes to see a good family disagreement, a good family argument. So there's not groupthink at the Fed, right? That everyone is free to share their own opinions around the table when they're having a discussion. He doesn't want to stifle that discussion, and he said that's healthy. And who would disagree with that? Of course, it's healthy. Now, there are probably more different views now at the Fed, a greater diversity of views at the Fed than ever before. And the reason for that is because of all the global events that have been transpiring, the tariffs. People at the Fed have very different views about whether the inflationary impact of tariffs will be long lasting or short lived. There's another disagreement about oil prices. Some believe that the impact of higher oil prices will feed through to other prices in the economy and cause an inflationary spiral, while others at the Fed think it'll be temporary, right? You'll have this spike in inflation. It won't spread to other prices. It'll be confined to oil and maybe some other prices, but it'll be a pretty narrow inflationary impact. So there's a disagreement about that. There's other disagreements as well. Some people are concerned that because we've had inflation, high inflation for 5 straight years, companies are going to simply view these high inflation numbers as permanent. And we're never going to go back to that 2% annual inflation rate. So companies will change their pricing behavior. From now on, they're going to expect 3% or 4% inflation, and they will make their prices according to a 3 or 4% inflation rate from now on. And those people at the Fed who have that view say, look, we got to raise interest rates. We got to slow the economy down. We got to cool off demand. Otherwise, 3, 4% inflation is going to become a permanent feature of this economy. Others say, no, no, no. Just look at market-based inflation expectations measures. They remain tame. They remain around 2%. So we're not getting this adverse effect of missing our inflation target over the last few years. It's not contaminating what companies think about forward-looking inflation. Okay, so these are all debates and disagreements that are going on, and that's absolutely fine. It's good for people to have serious discussions and share their views on these topics. But here's the problem. Here's the problem with this family fight. Warsh does not give his view. He doesn't say what his reaction function is. He doesn't give his view about inflation. He doesn't give his view much about the state of the economy in general. He just doesn't say anything. And therefore, because there's a void in communication, everyone else at the Fed is perfectly comfortable stepping in to fill that void. And we're hearing this public debate, these arguments in front of our very eyes. And Warsh isn't weighing in. There's no leadership at the Fed. And that's also undermining the credibility, right? Just imagine a CEO of a company, right? Imagine the CEO of NVIDIA, and um, and you have all these people from NVIDIA giving press conferences a couple times a week, and everyone is giving different views about the outlook, right? And they're contradictory views. What would that do to the value of NVIDIA stock, right? It would crater the stock. So Jensen Huang doesn't allow that, right? He when he gives a view, people take that as the view uh, of of NVIDIA. And the same thing has also been true of the Fed. Yes, people can come out and speak and give their views publicly, but everyone knew that ultimately Powell's voice was the most important voice. But Warsh doesn't have a voice. He doesn't give his view on the economy. He doesn't give his view on inflation. And it's been problematic. So, fine, no forward guidance. We can live with that. But Kevin Warsh, what's your reaction function? What data are you looking at? You don't have to tell us what you're going to do with interest rates, but at least let us know that you're looking at something and that you are a sound policymaker and that you're paying attention and you have a framework. And you've got to speak. You've got to speak clearly. If you just give muddled messages, then everyone else at the Fed is going to give their views, and we're just going to get these contradictory statements, and it's going to undermine the currency market, and it's going to undermine the bond market, and we're going to have problems. And that's one of the reasons why we have Scott Bessent coming in at the Treasury and having to buy back 10-year and 20-year bonds. That is not a healthy development. You don't want the government manipulating the bond market because it doesn't like the way the bond market is trading. And it is a creation, again, of the tariffs, of this war that has dragged on and dragged on, and this persistently higher oil prices, and this bungled message from Kevin Warsh. Okay, that's how we got here. That's why the Treasury felt compelled today to announce this government buyback plan. So it's all interconnected. It's all interconnected. Now, I want to get into the war a bit. Um, and Because this, if oil prices did come down, right? If Trump would just end, when I say end this war, I don't mean walk away from it. If he walked away from the war, the Strait of Hormuz would be under the control of Iran, and oil prices would never come down, and they might even, I don't want to say never come down because there are factors that ultimately will bring oil prices lower, but it would take a lot longer. The best course of action to get oil prices down and it would be to finish this Iranian regime off, right? To finish the war, to hit them hard, and that would bring down oil prices. It would bring down inflationary expectations. People wouldn't be so consumed about what the Fed is going to do next because inflation would start to come down. So let's jump into the war, and we cover this a lot because I do think it's the most important topic in the world and for financial markets. Okay, so Trump really wants a timeout. He just wants everyone to stop fighting, right? He just wants everyone to put down their guns and give it a rest. But since he can't get the bad guys to stop shooting, and by the bad guys, I mean Iran, Hezbollah, Hamas, the Houthis in Yemen, since he can't get them to cooperate, he's trying his best to use all his leverage over his allies, and by his allies I mean Israel, because there's only one other country that's directly involved in the war on the United States' side. So he's desperately using his leverage to get Israel, the good guy, to stop defending themselves against Hezbollah and Hamas. Because if Israel stops defending themselves and stops firing back, at least someone will stop firing bullets. And you can't get Iran, you can't get the bad guys to do it. So if I can just get Israel to do it, well, maybe I'm halfway there, right? At least I can pretend that peace is breaking out. And after all, right? After all, the US has stopped fighting, right? We've stopped firing bullets, even though Iran continues to fire. The press doesn't cover it very well, but almost every day Iran is firing missiles and drones at some international ship going through the Strait of Hormuz. And the US just isn't doing anything back, right? We're just ignoring it. So Trump is asking Israel, look, we're not firing back. Why do you have to fire back? Of course, when Israel gets fired at, it's impacting, it's killing Israeli soldiers, it's missiles on their own territory. So it's totally different. When the US is getting fired at, it's actually not on US soil. Right now, it's not harming any U.S. soldier for the moment, and they're not even firing at U.S. assets, right? They're hitting international ships. So, Trump is saying to Israel, look, we're not firing back. You shouldn't fire back. So just to give an example, on Monday of this week, Israel responded to attacks by Hamas on Israeli soldiers. Israeli soldiers are, you know, in certain parts of Gaza, which is, according to the agreement made between Hamas, the United States, Israel, and a bunch of other international actors. Israel is allowed to be in certain parts of Gaza now. And Hamas has been firing at Israeli soldiers, and Israel responded. And what did Trump do? He sent out a Truth Social post, and he scolded Israel. He scolded Israel for firing on Gaza, right? For responding to Hamas attacks. Uh, and he said they should not be striking Gaza because Hamas has agreed to lay down their weapons. Okay, in Trump's view, Hamas has agreed to lay down their weapons. Now, obviously, Trump doesn't believe it. This is a make-believe world he's operating in, again, because he just wants quiet right now. Midterms are coming, and he just wants the bullets to stop. So, Jared Kushner is was just in the Middle East. And before I get to Kushner, let me just say Hamas was delighted with Trump's criticism of Israel. In fact, you had the spokesman for Hamas, his name is Hazem Qassem. He said, "We welcome President Trump's statement, and we call on President Trump to put further pressure on the Israeli government to abide by the agreements reached to implement the second phase of Trump's peace plan for Gaza." Right? So forget the fact that Hamas is breaking the agreement for this peace plan on a daily basis. But since Trump didn't criticize Hamas, he criticized Israel. Of course, Hamas loved it. They're celebrating and they're jumping on the bandwagon and applauding Trump. Now, let's remember that Trump is publicly taking Hamas's side, at least for the moment. This is the terrorist entity that's an instrument of Iran that murders and rapes Israeli adults, women, children, right? That have not stopped their attacks, and they continue to seek Israel's destruction. But Trump is saying Israel should stop defending itself, right? And of course, he doesn't put it like that. He says they should stop firing on Gaza, but let's be real. He's saying stop defending yourself. Again, we're not defending ourselves, right? We're not defending our international shipping going through the Strait of Hormuz anymore, so you shouldn't defend yourself. Now let's get to Jared Kushner. Jared Kushner spent most of the week in the Middle East, and he even met with the leadership of Hamas. Okay, and who else was at that meeting? Turkey. Negotiators from Turkey and negotiators from Qatar were at that meeting. Now, you know who wasn't invited to the meeting? Was anyone from Israel, right? Israel did not have representation. Kushner is meeting. Imagine the U.S. government, meeting with Hitler after the Holocaust, right? And saying, you know what, we trust you, and we think that we can settle this, and we expect you to kindly put down your arms, surrender your arms. And who does he have at the negotiating table with Hamas? He has Hamas's two of their three biggest sponsors, right? No one from Iran was there, but Turkey, which is a huge sponsor of Hamas, and they're both Muslim Brotherhood countries, and Qatar, which is another huge sponsor of Hamas and also a Muslim Brotherhood country. So that's who Kushner and the Trump administration is trusting to make a deal. So incidentally, after that meeting, Netanyahu met with Kushner, and he told Kushner point blank, "You're holding meetings with the architects of the massacre of October 7th, 2023. Right? what are you doing? What are you doing? You think you can trust these guys? Okay, so there was a 20-point plan, right? The 20 plan was announced several months ago, and essentially that 20-point plan was the goal of the plan was for Hamas to truly surrender their arms, turn them over to either to Israel or some international body, and get all those weapons out of Gaza, and therefore Gaza would be demilitarized. And once that was complete, Israeli forces would withdraw from the heart of Gaza and just move to the perimeter of Gaza. The perimeter, so Israel could ensure that its borders were secure. So that was the summary of a 20-point deal. It seems like a good proposal, right? Of course, Israel said, good luck. It's pie in the sky. There's zero chance Hamas is ever going to relinquish their weapons, but go for it. If you think it's something you want to do, by all means, go for it. But remember, we are not withdrawing from any of our positions within Gaza. We're not going to put ourselves at risk, right? Not going to put ourselves at risk, but you go negotiate. And the Trump administration said, fine. But then the Trump administration recently realized, you know what? This is pie in the sky. Hamas is showing no signs of relinquishing their weapons. So we're going to come up with a new plan. And the new plan is called the 15-point plan. And instead of Hamas having to surrender their weapons to some international entity and those weapons being pulled out of Gaza, the new plan is that Hamas just needs to turn over their weapons to a Palestinian entity. And who is that Palestinian entity? They are Hamas people who now go by a different name. So they've just rebranded themselves. And those weapons will not be pulled out of Gaza. They'll remain in Gaza. They will be essentially put into a warehouse in Gaza. And Hamas, by a different name, will have possession. So this is the Kushner plan. So what's this all about? Well, it's so the Trump administration and the world, for the time being, can all make believe that there is a peace agreement being pursued in Gaza, right? And really, what Trump really wants to do is just let's make this all go away. Okay, we're really, if this plan actually went through, we're actually just allowing Hamas to reconstitute itself, to come back stronger, more fierce, more dangerous. But we're going to pretend that we're making progress. That's what's going on here. Now, Kushner came out of that meeting and he gave an interview to the US media. And he said that the Hamas leadership is saying all the right things. But then he went on to say, but it's obviously very hard to trust a terrorist organization that committed all these terrible atrocities. But we're going to give them a chance to perform. But it's going to be based on actions. Now, look, the actions that Kushner and Trump are asking them to comply with are not onerous, right? They're just transferring arms to themselves. That's all that's going on here. So when Israel doesn't accept it, who's going to get blamed for obstructing the peace deal? Obviously, Israel. And Israel cannot accept these terms. It's an impossibility. So it's not going to happen. But again, this is all about, I like to say, putting lipstick on a pig, right? This deal is an absolute pig. It's no better than the memorandum of understanding to open up the Strait of Hormuz that Trump negotiated with Iran way back in April, right? And nothing good came from that. It's just sort of a redo in terms of the idea of let's pretend everything is fine and dandy, and in fact, you're just creating more problems for yourselves. Now, how does this, by the way, the exact same thing right now. I won't get into the details that I just went into with Hamas, but we're seeing a copy paste with the approach to Hezbollah in Lebanon. Okay, the Trump administration is putting lipstick on a pig. Uh, Hezbollah in Lebanon has absolutely no intention of demilitarizing. The Trump administration is pretending that progress is being made. No progress is being made. Hezbollah is just reconstituting itself, rearming, and Israel is going to have to deal with this problem again down the road. So the same thing is replicating itself in all the problem areas. Trump just wants this to go away. Let's get through midterms, and then who knows what happens after midterms. But now let's turn to Iran directly and the Strait of Hormuz. So right now, as it relates to Iran, there are two critical numbers that are crucial when it comes to this war. Okay. The first number is 20 million. Okay. I'm going to elaborate what that means in a minute. 20 million. And the next number is 137. Okay. 20 million and 137. So what is 20 million? 20 million is the number of barrels per day. That is the commonly accepted figure for the average number of barrels of oil that was being transported through the Strait of Hormuz before the war started on February 28th of this year. Okay, 20 million barrels of oil was being transported through the Strait of Hormuz to the rest of the world, mostly to Europe and Asia. Now, the more that the US military can help get daily oil flows back towards this 20 million per day, the better, right? It would contribute to lower oil prices and release some of these inflationary pressures that we're seeing, not only in the United States, but globally. Okay, and that would also help bond yields come down, right? It's all interconnected. So that's the importance of this 20 million number I mentioned. Now, what about 137? Well, 137 is the number of days until the next US Congress takes its seats in Washington, D.C. on January 3rd of 2027. Okay? Now, barring a miraculous turn of events for the Republican Party, in all likelihood, the Democrats are going to control the House starting on January 3rd. And they even have a long shot at the Senate, but that wouldn't be the base case scenario. Now, even many Republicans who survive the election in the House, they're going to attribute the drubbing that their party took to, at least in part, to the war in Iran, to the higher oil prices. So, starting early next year, in 137 days, there is going to be a major drop in support from our politicians for not only the war, but even Trump, uh, blockading, putting that naval blockade over the Iranian economy, right? A lot of politicians are going to putting pressure on Trump to just walk away from this completely, which would be a true disaster. It would be a true, true disaster to U.S. reputation, to oil prices, to a lot of different things. But politicians are short-sighted and they don't understand that. So we have these two clocks ticking. And what is going to happen first? Are we going to get 20 million barrels a day first out of the Strait of Hormuz? Or are we going to have the Democrats take control of the lower house and support for this naval blockade collapse? Okay, those are the two clocks that are ticking. Now, I got to say that we are doing a reasonable job. all things considered, given that we haven't decided to take out the Iranian regime, um, we are getting oil through the Strait of Hormuz. So, according to Chris Wright, who is the Secretary of Energy, we're getting close to 9 million barrels a day through the Persian Gulf. Okay, not bad. And we're getting somewhere between 5 to 7 million barrels a day out of the Gulf area through alternative shipping routes, pipelines, and so on. So we're up to maybe 15, perhaps on some days 17 million barrels a day. So we're not that far off from that 20 million barrels a day. But the market doesn't trust it, right? The market doesn't trust it, and they think at any moment Iran might be more disruptive. In fact, the Houthis in Yemen are causing a lot of problems in what's known as the Bab el-Mandeb Strait, which is another waterway where oil shipments pass through. So there's a lot of risk premium right now in the oil market, even though we're not that far from 20 million barrels a day. Now, you can be sure that Iran understands the two numbers, right? The 20 million and 137 days until the new Congress takes their seats. And Iran wants to damage the Trump administration and damage the war effort as much as humanly possible. So they are rearming, they are gearing up. So is Hezbollah, so is Hamas, so are the Houthis, while the Trump administration is pretending everything is okay and not striking back and not allowing Israel or limiting Israel's ability to strike back. What are our enemies doing? They're rebuilding and improving their chances to be truly disruptive and send oil prices even higher to deliver Trump a terrible defeat at those midterms in November. So it's coming, right? It's coming. War is coming. And Trump is making a terrible mistake. Rather than taking it to our enemies and bringing them down so they cannot be disruptive, right? Trump is putting a lid on it. And by putting a lid on it, he's ensuring that the disruption is going to be much worse. He would be far better off ripping off the Band-Aid, pummeling the regime, arming the Iranian people and trying to get this regime to crumble as soon as possible. So by Trump is being incredibly short-sighted, he wants the easy way out. And in wanting the easy way out, he's creating more and more chaos. And again, this all comes together. It all ties back to the higher oil prices, the rising bond yields, and the U.S. Treasury stepping in today in a sort of an emergency situation, in their view, to try to cap bond yields, right? But this is a problem of Trump's own making. It goes back to the tariffs. It goes back to poor war management. It goes back to Trump trying to think he can have a prolonged ceasefire that's just allowing our enemies to rearm and rebuild. That's going to bring even more chaos down the road. So that's the situation. I'm still ultimately, optimistic. I do think we're going to hit 8,300 in the stock market by year end, but it is creating some turbulence, especially in the bond market and in the currency market for the dollar. So we'll pause here, see if there's any questions.